I'd like to show you why knowing your why is the start of your journey. Without a strong why, it can be so difficult to reach your maximum potential. My name is Dr. Jason Balara, and every week I meet with real estate investors and mindset specialists that are taking action in order to build a life according to their own terms. We will break down what drives successful people and allows them to achieve at such a high level. If you are a professional wanting to break through, or simply someone that wants to hear an inspiring story, the Know Your Why podcast is made for you. Hi everyone, I'm Jason Balara, and this is the Know Your Why podcast. Today I'm here with Vessi Kapoulian. Vessi has 18 years of business experience that includes 14 years of commercial lending and 4 years of business management. Vessi, as I said, I'm going to let you tell your story, but first let me just say thank you. Thank you for coming on the show today and taking the time out.
Thank you so much, Jason. I've been a listener of the podcasts and definitely honored to be a guest on the show now. So really appreciate the opportunity.
Awesome. I'm really looking forward to this. And for people listening, Vessi's also incredibly patient because the first time we were supposed to record, I was sick, had to reschedule. And then today I got stuck in a traffic accident and was late for this recording. So thank you for that. Thank you for hanging in there because I am very excited to have you share your story with our listeners. So let's start there. Let's just have you go ahead and kind of give us your background.
Absolutely happy to share that. My real estate journey actually started a while back, or rather I should say the real estate seed was planted in me a while back in Bulgaria. So I grew up in Eastern Europe behind the Iron Curtain during very different times. And at the time when people talked about investments, for the most part, they referenced hard assets like real estate and gold, silver. So you could say the thought of investing in real estate was really planted in me at that time. However, the seed didn't quite germinate years later. So I came to the US for school. One opportunity led to another, and just kind of followed the traditional path of completing your degree, joining a firm, and starting to climb the corporate ladder. So that seed didn't quite germinate until 2017, when I decided to buy my first investment property. And what triggered that decision really was a desire to diversify away from the stock market, which I discovered after I came to the US, but never really quite warmed up to. It felt very much, I don't want to use the word casino, but very, very volatile, not always predictable. So diversification was one of my goals, and really a desire to create a retirement nest egg. And that project turned out very well, so it prompted me to look to buy another home, and then another and another. And then the light bulb went on, and I asked myself, well, this is working well. How could I scale this further, not only as a retirement nest egg, but really creating another income stream? And that's what prompted me to look into multifamily. For me, that was a logical next step, given my experience in investing in residential properties, given my professional background. So my daytime job is a commercial lender. So a lot of skills that I could transfer and apply into scaling up into multifamily. So invested a lot of time and effort into education, networking, and really taking action, and ultimately completed that transition. And now looking to grow and scale further in the multifamily space.
Fantastic. So the first sort of real estate deals were residential.
Mm-hmm. Correct.
And tell us a little bit about that. Kind of what market were you in? What how did you approach that? I think it's nice for people to kind of know. Obviously, you know the lending side of things. So, but how did you approach those first deals?
Yes, so I initially stumbled across a real estate meetup, and there was one here in Los Angeles, and at the time it was all virtual. There was one particular speaker that would often talk about investing, and he had his contact information there. So one day I reached out and asked him, hey, do you know of someone who may have single family homes out of state. And sure enough, he did. So that was really my very first purchase. Why did I look out of state or outside of California? Because I really wanted to create that additional cash flow or additional income stream. So a little bit more challenging to do that here in California, and you can buy great, more affordable properties. So it was really the curiosity and picking up the phone and taking action. Now, I did go and visit that market, met with the property management firm, looked at the property. I had done, my very first property was in Memphis, Tennessee, and I know a lot of people shy away from that market, understandably so, because it's very street by street specific. So I had done a lot of research around the area, the location. Of course, like I mentioned, flew there to check it out and meet with the team. And I think a lot of that upfront due diligence made this a successful investment.
Excellent. And those were single family?
But that was a single family home, yes.
Okay. And then, so how many single families did you do before moving to multifamily?
I did 4. So 3 single family homes and 1 duplex. So 4 residential properties.
Gotcha. Okay. And so then talk about, kind of that transition into multifamily, kind of, I think we have a lot of people, myself included, like you kind of start maybe with that residential single family duplex mindset, and then you read enough, you listen to enough podcasts, you go to the meetings, and you're like, oh, scale. I want to do bigger. So how did that look for you?
Yeah, so again, it started really through a conversation and in networking. I was talking to an investor, and we're just sharing what we want to do long term. And I had mentioned, I want to buy my 10 residential homes or duplexes and whatnot. And from that point, maybe I'll consider multifamily. And then he said, well, you don't have to wait until you get to 10. You can start sooner. And frankly, from a lending perspective, right, even though there are a lot of transferable skills, a lot of good experience that you can leverage from the residential into multifamily space, lenders really want to see that multifamily specific experience. So accumulating 10 properties over a period of time wasn't really going to add a lot of value in terms of from a lending perspective and making that transition. So I decided to start looking into it at that moment and dove into a ton of content, networking calls, forums, boot camps, and whatnot. And almost every person I connected with, or at least the majority of the people, recommended a mentorship program or a mastermind. And so I started looking into that, ultimately decided to join one last year, and it really helped accelerate my journey for a couple of reasons. One, it provided a very more structured approach to the education component, which is very, very important, and I would encourage everyone to start there. But secondly, it provided a network of like-minded individuals who are motivated to do deals, have similar goals and values, and that's extremely important because multifamily is a team sport. There are a lot of aspects to the deal of acquiring the property, attracting capital, asset managing the property later on, and maybe you can do it with 1 or 2 smaller properties, but at some point you would hit that capacity. So it's always best to team up with others. So having that community of like-minded individuals is important in terms of finding your future teammates and partners. And that's kind of what happened in my case.
Yeah. The mentorship, I mean, you probably could figure it out over time without a mentorship, but it would take you quite a while. I mean, there's plenty of people that have done it. And I think those mentorship programs, they, as you said, they accelerate that learning curve. They accelerate your growth and your progress. And they provide the education, but probably more importantly, they provide you with a pretty big built-in network of other investors, but also a lot of the programs have, these are our preferred vendors. These are, they already have relationships with brokers, things like that you can, leverage to help with your own growth. So tell us about your first deal on the multifamily side.
Yes, so my goal was to close on the first one within 12 to 18 months of joining the program, and what really predicated that timeline was the environment at the time, which was extremely competitive. Now there are different challenges, and we can definitely talk about the current market. So I set that goal and really focused on taking action. And in my case, I decided to focus on two things in terms of market. I focused on Florida, specifically Jacksonville, Tampa, and Orlando. Why Florida? Because I already had some presence there via my residential portfolio. So it was familiar. I had people, contacts, and whatnot. And then from skill set perspective, I decided to focus on acquisitions. So finding a property and underwriting the property that was more closely related with my superpower and passion as far as numbers and underwriting. And so once I set that goal, and once I figured out what I will focus on, I started taking action. Initially going to the sites like LoopNet, Crexy, from there getting contacts of the brokers, then reaching out, eventually getting on their lists. Then I started to get the listings, and I would review each one that they send, especially in the beginning. Why? For a number of reasons. One, it helps you develop your skill set further, and for me that was underwriting. But also it helps you get to know the market better. So over time, you could look at a deal and very quickly determine, will that work, will that not work? It helps you be very familiar with certain components, and we can dive into that in a little bit. And I would always take the time to respond with feedback. Now, unfortunately, the answer wasn't always yes. So by the time I found my first deal, I had underwritten nearly 200 properties, so about a deal a day. It took me about 6 months to get to that one. And of those roughly 200, we submitted about 5 letters of intent, LOIs, and of those 5, only 1 panned out. So it was quite a bit of journey of persistence, but knowing your why is very important. And I very much relate to the subject of your podcast, because that's what's going to drive you and propel you further during great times, and that's what's going to pull you up during tough times. And so that's how the first property came along. It was I had always responded to that particular broker on time, very reliable. And when we presented the LOI, by virtue of networking within the community, doing my research on the market, for the most part, I already had the team to take that deal down. I wasn't waiting to find the deal in order to figure out the rest. So we had the team, we had the lender, the insurance provider, the property manager, and effectively gave them the confidence that we can close on that deal. So I don't know if we were necessarily the highest bidder, because we actually offered under asking, but we ultimately won that particular deal. I think it was because of the certainty of close, as well as local presence. I'm not based in Florida. I don't live in Florida, but one of my partners, actually 2 of my partners are there, so they're boots on the ground. So they were able to go the very next day, tour the property with our property manager, check it out. And I think that really presented well with the broker and ultimately helped us win the LOI.
Yeah. And I mean, so many important things right there that we can unpack, because you mentioned it before, and that multifamily is a team sport, and for sure it is. And your superpower, if that's acquisitions and underwriting. Now your background as a commercial lender certainly lends itself to that. And so I find like a lot of people, whether their background is real estate specific or what, there's always some connection. There's always something there that kind of helps you, at least in the beginning. You may be shifting careers, but you still have skill sets that are relevant from those previous careers. So you did some really smart things in that you built the team ahead of time, right? You did, while you were doing your underwriting, while you were, keeping up on these broker relations, you were building your team. And you mentioned something that I think is really important. You always followed up with those brokers. You always, gave them feedback on the deals. These are the things that, a lot of the mentorships, they tell you that to do these specific things because it works. And you're, sort of a perfect example of that. You did it, you did the work, you did what you were supposed to. And then, sort of were rewarded accordingly. I think it's just, it's simple, right? It's simple, but it's repetitive. Like it's not, you just got to do it. You just have to go through and do that stuff. And you did it at a time when the market was very competitive, and it was kind of hard to get in front of brokers. Right now, I tell people right now, people starting, this is the brokers will talk to you. Right. They're dying for someone who wants to do deals because everything has slowed down so much. And their position is more transactional. So they really want, so if people are getting started, you're listening to this, you're getting started. First of all, do what Vessi did. Do all those things, whether you join a mentorship or not, but do what she did in terms of if you're going to focus on acquisitions. But secondly, like, realize that it's actually maybe better timing right now in terms of creating those relationships with brokers, with property managers. People are start in a position where they're not inundated with work now. They're actually starting to look for it. So that's sort of part of what you said that I want to sort of focus on, but also just that team building aspect, that you put the team together ahead of time. How did you do that? I mean, what are some of the steps you took there that I think that's another thing that people say you should put the team in place before, but what did you do specifically to kind of develop that?
And I'm the type of person who takes their time. I know a lot of people go to conferences, they meet up with someone, and all of a sudden they start partnerships together. But for me, I took a more slow and gradual approach of getting to know my partners. They all are from the community that I'm part of, or the same mastermind. And there are various networking opportunities or events that are organized within that community. So I definitely took advantage and made an effort to attend those, or at least most of those. And once you start having those brief conversations, very quickly over time you figure out, oh, that I like that person, I want to keep talking to them. And also figuring out how you can help each other. So the light part is making sure you have similar values, similar business goals, more personal background, because these are people you'll be married to, right? Either forever, if you buy a forever buy and hold, or at least for the next 3 to 7 years if you do a syndication. So you want to make sure your values are aligned. So that's what it starts with, at least for me. Then business goals, and then last but not least, making sure you have complementary skill set. So in my case, yes, I have the underwriting and lender background, but it was important to have someone with boots on the ground, who has the contractor experience, and so forth. So all of these things came into consideration as I was trying to figure out who do I want to work with, who do I want to be married with, right, for the next several years. And it's I'm outlining it in a more technical manner, but it's really, all of that happens very organically. It happens over time. It happens naturally. So I would advise people, don't rush it, and take your time to get to know your partners and the people you will be with.
Yeah, I mean, it's really great advice. People get we all want to do deals, right? And you're like, how can I get this deal done? I need people to, because you really can't do it on your own. If you're going to do anything that's, sort of any substantial size, but it's that slow approach to it is better. And again, sort of not to harp on it, but going back to where we are at right now in the market cycle, like
this is a good time. This is a good time to go and figure out where are those partners that you want to work with on deals if you don't already have them in place. Like, who are the people you want to work with? So doing the networking, getting to know them, establish those relationships and their, sort of complementary skill sets, as you mentioned. You said, your role on the team is with underwriting. What are you doing now, kind of that might be different than it was a year ago when we were in a different place in the market cycle? What are you doing now with your underwriting to kind of account for, well, I guess first, maybe some of the factors that you are having to account for differently, and what are you doing with your underwriting in that regard?
It's a great question, and one I get asked very often, especially now in the current environment. I would first highlight a few factors. One is the rent growth or rent assumptions, projections, which also include vacancies. Then looking at the expense level, and I'll dive into each one in a moment in terms of how I'm changing those. So rent assumptions and rent growth, including vacancy, the expense factor, the cap rate, both the entry cap rate and exit cap rate, the debt terms, and the reserves. So these are the factors to focus on when analyzing a deal. So in terms of rent growth, we were very fortunate to enjoy high rent growth rates, but I think everyone who has been in the industry knows that those are not necessarily sustainable. And in fact, we are seeing rent growth moderate in some markets, and a lot of the 2023 forecasts are now coming out. So the CoStar, the big brokerage firms, are all projecting more flat rent, at least for my markets, and in some markets even declining rents, basically returning to a more normalized level. So as I review deals now, I take that into consideration, and looking at rent growth that's more closer aligned to maybe historical rates, and maybe even lower, particularly for 2023. Vacancy assumptions as well. Again, due to shortage and unprecedented demand for apartments, vacancies were very low. However, in parallel, a lot of operators were also pushing up rents quite a bit. And now we're hitting that affordability cap that exists because wages didn't increase 20-30% over the last couple of years. So a lot of people are having to relocate to different areas, maybe different states, simply because they cannot meet even the rent requirements. We saw the unemployment numbers today. Those are highly more encouraging than anyone expected. But I think the general consensus is that next year, or 2023 rather, this year will be softer. We'll likely experience a recession, and depending on who you talk to, maybe depression. But all that it means is that with rising unemployment, people are more likely to also have difficulty meeting rent obligations. So that may lead to some economic vacancy as well. So I look at the longer term historical trends and get closer to that versus the 5% or lower vacancy from the past couple of years. On the expense side, there are two factors. Your largest expenses are your taxes, insurance, and labor, which includes property management. So given the continued increase in valuation over the past couple of years, the assessed property values have increased. So that's certainly something to take into consideration. And that's very state specific, even county specific, but at least in Florida, the reassessment happens every year. In some states, or counties, it may be every 5 years or every 3 years. So if you just bought a property and it was reassessed and the next one is not due until 5 years, you have that arbitrage period. So I encourage people to look into that and make sure they're familiar. Insurance is a very hot topic right now. And I first started underwriting deals, 400 to 500 was the norm. It's not uncommon to see $1,000 per door currently in my market, and that may go even higher this year, given the hurricane that we experienced last year. So I always encourage people to check with your insurance broker, and especially now check multiple times, because it's not uncommon for the insurance rate you thought you would get to change at the closing table, and you don't want to have those surprises. And of course, labor and property management fees. So that's the expense side of the equation. The third item I mentioned was cap rates. So your entry cap rate, which is not necessarily the cap rate you buy the property at, but rather the market cap rate. We've already started to seeing some reversion of the cap rates who were declining over the past couple of years. And now, given the rise in interest rate and change in lending terms, those are starting to increase. And even in my market last year, deals were trading at 3 to 4 caps. Now they're at 5, 5.5, 6 caps. Again, that's very market and sub-market specific. So taking that into consideration and accounting the more rapid rise in interest rate, which inevitably impacts cap rates, into your reversion assumptions. I know historically many operators would look at 10% 10 basis points a year. I'm looking at a higher gap now because of what's happening in the market. I mentioned reserves as number 4. So typically I'd like to look at least 6 months of operating expenses and debt service. I know that's probably on the more conservative side, but from my experience, cash and cash flow is what helps carry you through downtimes. In the past couple of years, yes, a lot of that was with the rising cost in materials and labor. So you certainly don't want to have surprises once you start a project, but especially right now with higher rates and vacancies, you want to have that extra cushion or buffer. And last but not least, debt terms. Your lender is your biggest partner, and providing, well, up until last year, it was 70 to 80% of the equity. Now it's closer to 50, 60, but that's still a considerate amount of the capital stack. So your debt terms, your rate, repayment, all that matters, and making sure that also aligns with your business plan, right? Right now, a lot of people are getting into fixed rate debt, and that's what my personal preference would be. But if you get into a 10-year deal and your business plan is really to exit in 3 to 5 years, then make sure you factor in those prepayment penalties in your analysis and calculations, because especially in an environment where in the long run rates are likely to fall, and when we look at that, when we look at the 10-year treasury bill and whatnot, the prepayment penalties are likely going to be higher depending on what kind of prepayment penalty structure you have. So you want to factor that into the equation. If you have a shorter term project, maybe look for shorter term fixed rate to align that with your intended or projected close date. So yeah, those are the 5 factors I typically would focus on as I dive into a deal. And I forgot to mention the very one that's really the most important, that's the market or sub-market, because you can do a lot of things to a property, but you cannot really move its location. So making sure the median household income, crime rates, poverty rates, all that meet your criteria. Because if you let's just say you have median household income of 30,000, and you think your broker is telling you, oh, you can get $1,500 to $2,000 rents, that's probably not going to happen if people can't afford to pay that rent. It definitely impacts your business plan, or how the market impacts your business plan, how you execute on the business plan. And it could be the tailwind that propels you further during good times, or what gives you some cushion during stormy waters.
Yeah, that's people should go back and listen to that 2 or 3 times. I mean, really, like, just a fantastic breakdown of underwriting, Vessi. The highlight pieces and of what's most important, your biggest expenses and all of that, but really just kind of it's a great explanation and putting it all together. I wanted to ask you, obviously, I think your background as a commercial lender impacts your ability to be good at underwriting and sort of have that be your superpower. But do you approach it any differently? If you're underwriting a deal for acquisition as sort of the operator, the investor, versus you're underwriting a deal from the lender side of it, or is it kind of the same? How does that tie together?
No, that's an excellent question, because my experience was really on only one side of the table or one side of the equation. That's namely the lender side. There's so much more that you take into consideration, I think, as an operator, because you're the one, right, who's creating the business plan, and you're the one who will be ultimately executing on that business plan. So being familiar with how to run the property, what it takes from an asset management perspective, all that, there was some learning curve on my end, and that's where I think the educational component was very helpful. Also, my particular lending background was with a more traditional lender, recourse type 525 or 725 types of structures, exploring the agency world, non-recourse world. All of that was new territory for me. So certainly took time to understand those options as well, and the requirements associated with that when it comes to your experience, your background, the key principles and whatnot required in order to take, especially for larger deals, down. So there was definitely a learning curve for that. So yes, there are a lot of transferable skills that you can leverage, but there's also a lot more to learn as an operator. A lender would always look at your projections and dial them down. So that's also something to take into consideration when you present information with them. So it's helpful to have an understanding of the other side of the equation, but there are certainly nuances that I had to pick up as I was learning the underwriting from an operator perspective.
Yeah. It's kind of a funny point. The brokers, when we get the pro forma from the brokers, we're gonna dial it down, everything from what they say, and then the lender's gonna take our pro forma and dial it down even further from there. So it's definitely it's risk mitigation, right? It's like the broker's job is to sell. Their job is to sell, make it look as good as they possibly can. Our job is to sort of protect the money of our investors, right? We're protecting our within a syndication, and then the lender, as you mentioned, is our biggest partner, and so they're sort of trying to protect everybody. So it's just like deepening levels of risk mitigation in terms of the underwriting and how you pro forma the whether it be the rent growth or the expenses. All of it obviously factors in. So I think really excellent points. I feel like we could talk about underwriting for hours, but let me switch gears, Vessi. I want to get to ask you the questions that I ask every guest. First one, you touched on it, but the name of the show is Know Your Why. And so what is your why? What drives you? As you said, there are going to be ups and downs, and so it's easy to keep going when everything's good, but what gets you going, keeps you going when things are tough?
Ultimately, what drives me is I want to be able to live a life of significance and purpose. And I see financial freedom as a vehicle to achieving that. And that freedom means a lot of different things to a lot of different people. But to me, that translates into being able to spend time with my family, being present for them, being able to take care of them. For now, that's my parents, but eventually, hopefully when I have a family one day, being able to spend more time with my kids, and then finding other ways to give back to the community and having more time freedom to do that as well. Not that you cannot accomplish that while having a regular W-2 job, but I think everyone's here for a reason. We all have a purpose, and finding that purpose maybe takes some time, but it was very empowering and refreshing when I discovered that. So it's living that life of significance and purpose is what drives me. And real estate is just a vehicle. There are many vehicles to accomplish that. You could start a company, invent a product, but my natural passion, skill set, interests revolved around around real estate, and that's why I chose that particular vehicle.
I one of my favorite things about kind of this podcast, and even the the conferences and stuff like that, you know, you hear the speakers, and there's this point where it's like you become successful, whether it's real estate, business, as you mentioned, it doesn't really matter. It's all a vehicle, but you reach this point where you've become successful, you're financially free, and then it's almost like you get this like switch that flips, and it's like, wait a minute, now what can I do? Like what impact can I really have? And listening to, you know, some of the people that have just been incredibly successful in the space at the conferences, and now it's like literally everything they do is to have an impact, in the real estate business is just kind of funding that impact. It's so cool to see that stuff. So yeah, I love that. Tell us something about yourself that maybe isn't common knowledge, special skill, a hobby. I mean, anything that you're comfortable sharing, so the audience gets to know you a little better.
Well, hobby, in terms of hobbies, running is one of my hobbies. I really enjoy it. And most people start with 5Ks, 10Ks. I always enjoyed running. And one day a friend of mine were chatting and decided to run a marathon. So I went from 0 to a marathon and eventually dialed down to half marathon. And now I just do 10Ks. But that's that's how it got started.
You did go the opposite. And I mean, you know, for people that run, they know but like the difference between a marathon and a half marathon is like
Right.
I honestly feel like anybody who's in decent shape could go do a half marathon
Right.
with very little. I do not think that is the case for a marathon. It's a totally different world. So good for you for starting big on that. That's impressive. When people hear this and they want to reach out to you, what's the best way?
The easiest way to connect with me is through my site, www.dbacapitalgroup.com. D as in dream, B as in believe, A as in achieve. And my contact information is there, phone, email, as well as a calendar link in case people would like to set up a time and schedule a call. Also, as a special gift to your listeners, I would like to offer a complimentary copy of my very first digital book. It's not published yet. It will be published later this year, but I'm happy to share a copy with them ahead of the launch if they can contact me through the website, and I will share the links with them.
Awesome. Yeah, we should all reach out to get a copy of that. That's exciting. Final question for you. What is a piece of advice you would give to someone who is getting started? They want to be a real estate investor. They're kind of just getting ready to dive in. What would you tell them?
I would say first get educated. That's important, not only for your own edification, but also you have responsibility towards others, whether it's your partners or down eventually your investors. So get educated and then take action. Your first deal might not be your perfect deal, but you will learn a ton, and that experience is invaluable. So don't wait to find a perfect deal. Don't overanalyze. Definitely take calculated risk, thoughtful action, but take action, even if it's a small step. So that goal of buying your first apartment building may seem really far away and really intimidating, but think of what is that first step I need to do to take that property down or to get there, and then just implement it and take a small step every day, consistently and persistently. And before you know it, you will be well on your way of making those dreams a reality.
Yeah, it's absolutely true. Vessi, this was great. I really appreciate your time. I'm glad that you were patient enough to hang in there and let me get to the computer. So thank you for coming on. Thank you for sharing your story. Thank you for the really all the value you provided. I think people can take a lot of very directly actionable information from this, especially towards their underwriting, but also just, you know, kind of the steps you took in getting started. It's all great. So thank you. I really do appreciate it.
I really enjoyed our conversation, Jason, and thank you for having me as a guest.
Yeah, absolutely. Folks listening, I know you're going to love this episode. Please connect with Vessi. She's going to give you a copy of her digital book, which is very, very generous. But if you like the podcast, please like, rate, and review so we can have more great guests like Vessi. All right, take care.
I'd like to show you why knowing your why is the start of your journey. Without a strong why, it can be so difficult to reach your maximum potential. My name is Dr. Jason Balara, and every week I meet with real estate investors and mindset specialists that are taking action in order to build a life according to their own terms. We will break down what drives successful people and allows them to achieve at such a high level. If you are a professional wanting to break through, or simply someone that wants to hear an inspiring story, the Know Your Why podcast is made for you.